Ladies and gentlemen, allow me invite Mr. Vincent Tumwijukye, the founder and CEO of FutureLink Technologies, to deliver a speech themed "How can startups coexist with growing regulation and licensing demands?" Thank you so much.
So Nicholas just introduced me, and I just wanted to take a few minutes before I dive into this to say something about FutureLink. Yes, as Nicholas has mentioned, it's 18 years ago when we started in a garage on Kamocha with $300 equivalent, that is 1 million shillings, and with a borrowed desk and a chair. And we have seen typically what a startup in Africa goes through. Talk about walking, long distances because you don't have money. You're talking about, crossing flooded areas, the Boise areas, and almost drowning, falling into a manhole, coming from work late in the night, and reaching home without shoes and with mud. And the next day you realize that actually you had one pair of shoes and you have to go to work in sandals. That's the kind of resilience that is required for an African entrepreneur. And like Nicholas has mentioned, we are a community-driven marketplace for financial services regulated by Bank of Uganda as a national payment system operator, serving about 1 million people with over 340 circle branches across the country, but also having others in Zambia. The story that I'm going to share with you is one that is informed by our own personal experiences, and perhaps some of you can relate with and be encouraged to actually walk in to make this world a better place. So, speaking to a startup, what is a startup? A startup is not a small company. It's not a young company. A startup is an entity that is seeking to do things in a different way. A startup is a company that is looking out and developing a new business model, a scalable business model that is meant to serve hundreds of thousands and millions of people. So that is what we call a startup. So I know that there are some startups, but you can be an old company, you can be a big company, you can have a lot of money and still be a startup. If you are changing the industry, if you are coming up with business models that work for the unincluded, the excluded. So that is the startup. And I would like to put, a startup in 3 phases. So you start the early stage startup, so many of us are in that stage, early stage. So you will fund with your own savings. You will perhaps speak to your own relatives who will give you some money. And some of you, like me, you will actually be able to work without money for months. So I know what it means to be to wake up and come to your garage as it is, and you find a padlock because you have not paid rent. So a startup is really a rough journey. And if you are not signed up for that, then you are in the wrong place. So that is the early stage. The second stage is the growth stage. So you have figured out your business model, a scalable model. You have achieved your product market fitness. You know that you have a product and the product has available customers to be able to pay for it. That usually takes some time. Now, the challenges of growth stage the conflict that we're going to be talking about with regulators. Because here you are talking about money that is not necessarily yours. It's money coming from venture capitalists whose cycle are usually 10 years. So every VC, somebody has raised money from a VC here? Just put up your hand. A venture capital fund. Oh, Kalunji, we have some work to do here. Because I think that many of us may be starting these companies as self-employment. A startup is not just to give you a job. It's meant to serve millions of people, employ more people, but leverage other people's money to be able to scale and serve the nation. So this is now perhaps what is relevant to you. So if you have figured out a working business model, the next stage is to acquire financing from venture capitalists. Now, the challenge of that money is that they are usually limited. The fund is usually about 10 years. So when you raise money from a VC, a fund that has only 5 years left, it means as you draw closer to the end of the cycle, they need to get back their money to be able to pay back the investors. Are we together? Now, usually that is the conflict because you need things moving faster. The scale. So the investors will be saying, but where are the million people that you said you would acquire? And then the regulator is saying, no, you need to slow down. You need to make sure that KYC is complete. So this is usually the conflict in which we are going to be speaking about. And I'm happy the minister is here. I also happen to be the chairperson of the National Financial Inclusion Strategy Working Group in charge of the deepening of the usage of financial services hosted at the central bank. And these are the questions that we are speaking about. You cannot have a regulator or regulators who are not familiar with the cycle of VC funding. It becomes extremely frustrating. So this is the conflict. So a startup will be driven by revenue. So as you can see, it's revenue. You said you're going to make, $1 million annual revenue. Where is the revenue? It is driven by impact because these VC venture capital funds are set up to create impact. So where is the impact? Where are the women? Where are the youth? So, and then you have investors. So the drivers of a startup are these three. And then, of course, when you have gone through the growth stage, then you have the private equity. These are big funds which can give you, millions of dollars for you to be able to expand to other markets, replicating your business model. Now, when we look at the next slide, these are now regulators. The regulatory authority. Who is a regulatory agency? This is an entity that is established by government in order to regulate and license some human activity, some areas of human activity in the interest of the public good. So, for example, you have, in the case of fintechs, you have the central bank, which is mandated under the National Payment Systems Act to regulate fintech activities. But in that, you have also the Financial Intelligence Authority, which is in charge of anti-money laundering. Then you have NITA, which through the Electronic Transactions Act, they are supposed to make sure that they monitor systems that are handling intermediation, money intermediation. And then you have personal data protection, again, that is NITA. Now, if you are a startup and you are thinking about a business model that is meant to serve millions of people, you need to be aware of this. And by this, if you have not, please, don't keep hiding. Don't keep hiding because it is very risky. It's riskier to have gone if you are traveling to Mbarara, to have gone to Masaka, and then you are told, you need to come back to Kampala, because the regulator has power to do that. So, these are the conflicts. Now, the drivers of regulators are three, in my opinion. One is risk. So while the startup is talking about revenue, you cannot say, if I can only do this, I am going to make a lot of money. The regulator is not interested in how much money you're going to make. The regulator is interested in what is the risk. So you need to understand where they're coming from. And then they are also interested in impact. So if you are a startup, clarify your impact on the nation. How is your work impacting lives in the rural area? Measure it. Quantify it. Bring it out in a story. So the regulators are able to understand that when they restrict your activities, they are directly impacting the rural population. And then it goes also without saying that the regulators are influenced by politics, politicians. That is another truth. Because every government comes with an agenda. And this agenda is implemented through regulation. So if they don't understand you, a startup, you are at a disadvantage. So you don't present, how much money you're going to make. When you are speaking to regulators, you must address how your work is going to, 1, address risk, 2, address impact, and 3, address the politics of the time. If you ignore that, you are headed for clashing with the regulator, and they have the power. Now, having addressed how the different two players are coming, the perspectives, the backgrounds are different. Now, we go to the conflict. So you have the startup, and the founders usually are optimistic. They know they're going to make it. There was a time when we were raising money, and we spoke to this individual and explained how much money we're going to make. And this guy, sat down and listened to us. Those were many years ago. And after I had passionately really spoken about how much we were going to make, the guy said, in dreams, you cannot lose any money. In other words, he was telling me to wake up and wake up from the sleep. And usually that is the dilemma that founders have. We speak only from dreams. We speak how much money we're going to make. And forgetting that sometimes the people we are speaking to are not driven by how much money you're going to make. So they are always optimistic. The regulator, on the other hand, is pessimistic. They actually want to understand what could possibly go wrong. So when you are speaking to the regulator, understand where they are coming from. Because when things go wrong, they lose their jobs. And then you have, the startup wants to move fast because of the pressure of investors. Sometimes people who have given you money, now they want it back, or they want it at an interest. So how do you actually address this? You must go fast, but the regulator will want to go slow. Why? Because slow is stability. They seek stability. They don't seek to change things. Okay? Then the founders are usually tech savvy. They understand technology. On the other hand, many regulators, will not be as equally tech savvy. Then the founders have the big desire of a bigger market. They want to be here in Uganda, but they also want to be in Zambia. Now, for the regulator, the more customers and the more geographical areas, the more markets you serve, the bigger the risk. So they would be happy to constrain you in one market, which they understand. So if you're going to go to another country and you are speaking to the central bank, please come with the way you are going to address this risk from their own perspective. Because they would be happy for you to serve a smaller market, which they understand because it brings down the risk and the amount of work. And then, of course, the startup is inspired by the customers and investors. On the other hand, the regulators are influenced by the politics of the time. So understand them. If you're going to have a relationship, and a good relationship that can influence how regulators work. Internally, this is something that I would like to propose to you, the PARC model. The PARC model is an acronym that you could use. One P stands for people. The people that are in your organization. Are they people of integrity? Do they desire to learn? Do they have ownership? If you are a startup founder, you are going to find that the people you're going to employ first and foremost must be owners. How do you include them in the decision making? Because it's very difficult to comply with regulation as an individual. The regulator, you will have traveled, and the Bank of Uganda will be asking for some report. You will have heart attack responding to different regulators. Because as we have noted, you have the Bank of Uganda, you have NITA, you have Financial Intelligence Authority, you have NITA again for personal data protection, and then you have different audits. You cannot do it as an individual. So what FutureLink has done is to, for example, come up with employee stock ownership program. So people who work with FutureLink can actually become owners of the company. We try to be as transparent as possible. Everything that the revenues and everything, everyone knows. Because there is nothing to hide. I mean, your revenues and your financials are going to be submitted to the central bank, and they're going to be published at the end of the year. So your employees should not be learning your financials from the papers. So when you demonstrate that you are an open book, people buy in, people work together. And then the architecture. Architecture is, the kind of organizational structure that you have. Do you have an organizational structure that actually works? Do you have a functional board? I remember when we set up our first board, in that garage. We would sit in that garage and call it a board, prepare reports without even revenue. I am surprised that a company, you have gone to 100 million and you don't have a functional board? Are you serious? Do you really mean to actually scale over Uganda and go to another market? Or you are creating for yourself a job? You are self-employed. So set up a board and be accountable to it. Allow them to ask you tough questions. If you are going to be, the startup as we have defined it, we have said a startup is not necessarily a young company. A startup is a company that is seeking to do things differently. You can be $1 million, you can be $100 million and still be a startup. Amazon is still in a way a startup because it is changing how people work, how people live. Google still operates as a startup. So it is a new way of working. And then routines. R stands for routines. Do you have some unwritten rules that bind you together as a family, as a team? Celebrating birthdays and recognizing the contribution of different people is part of how to build a team that works together. And then lastly, the culture of transparency. Is it a fair play within this company? Are you playing fair? Are the people interested in learning? Is it a collaborative team? Do people actually willingly contribute? Or it is a competition? When you find people competing, withholding information from colleagues, how do you actually grow in such an environment? People are scared of their jobs. They cannot leave a glass of water and come and take the water. You have people, you cannot be a startup And people are watching their back. They are fearing, that they could be poisoned. You leave those things in these big traditional companies. But for a startup, you need everyone hands on the deck. And because of that, people must begin to feel safe. They must feel safe in the environment. Because when people are safe, they are willing to give their whole. When they are safe, they are willing to actually defend the company. When they are safe, they are willing to actually watch for the company. When they are safe, they will tell the risks that are coming. Now, as we conclude, having sorted out the people element, the culture, the architecture, these are some of the steps that you can actually take deliberately. 1, clarify your mission. As you noted, both the startup and the regulator are interested in impact. So if you are able to clarify your impact, that is the convergence area. No regulator will outrightly outlaw impact because they know when the politicians investigate and find that they were, they will be careful to shut down something that is creating positive impact. So clarify your mission. 2, establish impact metrics. Begin to measure this impact. For example, we know of the people that are being served on the platform. We know that we are measuring savings per capita on our platform. We are able to tell that last year, for example, savings per capita on our platform, with all the people that are being served across the 340 circle branches, we know that savings per capita grew from 290,000 to 320,000. That's a positive. So begin to measure this impact. And then maintain a comprehensive risk register. When we are raising money and sometimes I look at some brothers and sisters talking on TV and all that. Founders are good to tell just the positive story. We want to tell the positive story, only the positive story, ignoring risk. But when you begin to actually operate at scale, I can tell you, the risk that is there could actually write you off. So be comprehensive and honest about your risk. Maintain a risk register. And in that risk register, quantify the value, monetary value of impact. Sometimes we say, financial risks, but we don't quantify if this event happens, what is the monetary impact on my company, on my strategy. When you clarify the impact, I can tell you, you will not have sleep until that issue has been addressed. And that is one of the ways to include everybody, because once everybody understands what is at stake, you are able to buy in. They are able to buy in and give you their whole heart. Next, maintain a compliance matrix. So as you can see, we are reporting to different bodies. And that is not to mention the different audits that have to happen. So it is important to have someone that is watching over the risk. And don't say, I am still a small company. Be fair to all. Be fair to all. Play a fair game. Because I have said startups are companies that are seeking to do things differently. And because you are seeking to do things differently, you will be affecting some people in the ecosystem. So be intentional to play fair. Because that is the way you will get the goodwill from the people. And you must grow up. That is the next thing. This business of saying, we are still a company, a small company, why doesn't Bank of Uganda, favor us? I will give you an example of what happened. So we had just gotten a license from the central bank, and it was in December. What I did not know, I thought, okay, so in December we have just gotten a license. So there are requirements which cost money and whose deadline is on the 30th of January. So we have gotten a license in December, and there are deadlines. We have just paid money for the license, and there are deadlines, a particular deadline that is due 30th January. Now, I thought that since we've just gotten a license, this license should at least last me, a whole year, right? So I go on. I'm a small company. The central bank should understand that, right? So the deadline comes and goes. And then on the 15th of February, I receive a letter. Show cause why you should not be penalized. And every day of default was 2 million. And now it is 15th. That is 30 million shillings. Why you should not be penalized. I started literally shaking. And then I called some people that I had, known at the central bank, and no one was willing to pick my calls. And finally, when this person actually spoke later, when the issue had been resolved, the person told me, when this issue arises, please don't call me. We are not going to be babysitting any company. It was a call to actually grow up, because sometimes some initiative is lost from the will. We think we do not have the will to comply. There is initiative that is lost from the lack of will to comply. But I can tell you, if you are going to grow a business, attract investors, and scale to other markets, which we badly need. By the way, Uganda is doing very badly. This is why I am very passionate to share my story. Because when there is only one company that is able to attract funding, it becomes very difficult for the next to actually attract funding. Extremely difficult. You will hear investors saying, oh, we love you, the traction, we love the progress, but we would like to hear from you when you have crossed over to Kenya. Why? Because there are very few companies that have raised the money here. So it works for me and works for everybody when every company that is here is doing their best to shine the light of fintechs and inclusion. So we must grow up. And then lastly, comply. Do your best to comply. And with that, I hope this aspiration that FutureLink has at heart can come to life. A better Africa with financial freedom for all. I thank you very much.